Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of September 25th. Stocks fell last week for another week. Many reasons drove this weakness, including the UAW strike, higher oil prices, and a potential government shutdown. Of course, the biggest market mover last week was the Fed meeting on Tuesday and Wednesday. The Fed did not raise rates as we all expected, but they did release their updated version of the so-called dot plot. And their dot plot said they expect one more hike this year. This is a little bit of a surprise. This surprised the markets. Also, the market's focused on, given the recent strength of the economy, Fed officials now see interest rates falling to 5.1% at the end of next year. This is higher than June's outlook for rates to finish next year at 4.6%. All it says to the markets is that the Fed will be a little bit higher than longer, a little bit more hawkish than markets had anticipated. Overall, this is pretty consistent with our thinking. We've been saying for a while the Fed is pausing. The Fed still needs to see the effect of rate hikes on the economy. Also, inflation is starting to roll over. And the Fed likely maintains its higher for longer perspective, in our opinion, because inflation is still above the Fed's 2% target and services inflation is still pretty high. So let's talk about this week. This week should be a very quiet week for economic data, but we also want to understand how the consumer is holding up. So we do get a key report on August consumer spending on Friday. So what I'll do is discuss what is expected on this report and why we expect data, the data to come in a little bit lower than markets expect. So what is expected? The consensus expects consumer spending to slow from July's 0.8% to 0.5%. This makes sense because the consumer is starting to feel pressure. Savings is starting to come down. Student loan repayment begins pretty quickly. California tax bills are due in October, and higher interest rates are starting to be felt in credit card borrowing. We think overall report will be lower than expected because of three distinct reasons. Number one, oil prices are up about 30% since June, starting to be felt in gas prices, as you see here. And we all know higher gas prices reduces consumer spending. Number two, the August retail sales report came out about 2 weeks ago. It was pretty lackluster. Goods spending was weak. Services spending was mediocre. Number three, wage growth is starting to slow a bit. As you see here on the right, wage growth is starting to weaken a little bit, and weakening or slowing wage growth will also impact consumer spending. So the big takeaway, over the past couple of years, we've seen housing, autos, manufacturing in recession. On the other hand, our economic savior has been the consumer. But signs are getting more clear that the consumer will be under pressure. The silver lining, though, however, is that if the consumer slows down enough, this reaffirms to the Fed they no longer need to raise rates anymore. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and I'll see you next week, and thank you.